Welcome to Safe Option Strategies presentation of the bull put spread. This class is a production of Safe Option Strategies and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk, and you are solely responsible for any losses you may incur as a result of trading. All right, we are going to make a pretty dramatic shift right now. Up to this point, as we've gotten into and this is for the sake of those who are going through the education right in order of how it appears on the website, which you don't have to do, but a lot of people go in order like that. We have gone through the basic main debit spreads, trades where we are spending money for the sake of being in that trade. Now that's a fairly easy concept for people to understand, even when options are a little bit new to them, even when spread trading is a little bit new to them. It is still an easy thing, relatively speaking, to wrap your mind around that you're going to have to pay money to be in a trade. You think of any investment vehicle that you've ever used in your entire life. If you've bought real estate, if you've bought artwork, if you've invested in a company or a business, meaning like as a business owner, not as a stockholder. If you've bought stock, typically when we think of making an investment, we think of paying money to be in that investment. And now we're going to shift gears. Now we're going to suddenly turn and say, we're going to look at investments that actually pay us initially. They pay us to be involved in the investment, but we're getting paid to take on certain risks and to take on certain obligations. And the starting point for this is the bull put spread. People love credit spreads because they love this idea of getting paid to be in a trade instead of paying money to be in a trade. The bull put spread is a credit spread, meaning that there is money in. The end result of entering this trade is that money has come into our account. We sell to open the trade, therefore when it's time to close the trade, we buy to close it. Now there's still one of the options that we use is going to be an option that we buy. One of the options that we use is going to be an option we sell, but the net result is money in to open the trade, money out to close the trade. The spread takes advantage of a bullish move, or it can take advantage of a stagnant move, provided the stock price stays at or above a certain level. So you don't have to have the name of the trade indicates that we want a bullish move, and that's accurate. We would like for there to be a bullish move for this trade to work in the best way. But the trade can still be profitable and can still work very well with a very flat, very stagnant move. We just don't want the trade to move bearish on us. Our short put, in this case, is our primary money-making option. And that's a big change from the debit spreads that we've been going through. With all of our debit spreads, even though they have included a short option, it's the long option that has been our primary money maker. We're going to reverse that now. The short option is placed out of the money. Notice we didn't say at or just out of the money. It needs to be out of the money. And it also needs to be, I think this should say, it needs to be below. I'm sorry, I was going to change that to above, but this is correct. It needs to be below a strong level of support. And preferably in the current or no later than the next month of expiration. This is our primary money-making option. Okay, so let me read through this one again, since I kind of screwed it up for you as I was going through it. The short put is placed out of the money. That's the first important thing. We want it to be out of the money. We would like there to be a strong level of support at a higher price than the strike price of our short put. And I'll show you why in just a moment. And then we want that short put expiration to be in the current month of expiration or in the next month of expiration. Our long put is then going to be placed one or more strike prices lower than the short put and in the same month or week of expiration. That is our hedging option. The cost basis. Now this is again a deviation from what we've talked about previously. That things change right here. The cost basis, since we're not spending money, we can't refer to the cost basis simply as the money that we spent to be in the trade. Does that make sense? In all of our debit spreads, our cost basis, which is also our maximum risk, is equal to whatever we spent to be in that trade. Well, we're getting paid to be in this trade now. I've heard some people refer to this as a pay-to-play trade. You're getting paid to play in this trade. In this case, the cost basis is going to be whatever the net credit is that we receive. So we take in money on this short put, we spend money on this long put, it results in a net credit. Whatever that net credit is, we are going to subtract that from the difference between our two strike prices, and that is our cost basis. And our cost basis is equal to our maximum risk. They are one and the same. That is the maximum amount of money we can lose. The maximum reward in this case is simply equal to whatever the net credit is we take in. And we can calculate a return on risk. Now, in debit spreads, you've seen us use the acronym ROI a whole bunch of times. Return, this is a return on our investment. We're not making an investment here, we're taking in a credit, but we do have risk. And our percentage return is based on how much money we make versus what we have at risk. Because even though we're not spending money to be in this trade, we are taking on risk, and it's a very definable, very calculated risk. A good return on risk can be anywhere from 15 to 50%. 20% is preferable, but I will tell you right now, and I will emphasize it later in the program, I'll repeat it for emphasis, typically we don't want to enter a bull put spread that we cannot make at least 15% return on. This 15%, with very few exceptions, that needs to be kind of a hard line. There are a couple of exceptions, but more often than not, you're going to look at that as a hard line. You want to get at least a 15% return. Good target time in the trade is less than 4 weeks. Just the opposite of most of our debit spreads. When we put together a debit spread, when we spend money to be in a trade, typically time is going to be our enemy. We want things to progress a certain way within a certain period of time, because if it doesn't, we start losing value in those options, and we don't want to lose value in those options. In a credit spread, the best possible thing that can happen is if we lose value in those options, and the quicker the better. The faster that happens, the better off we are. Okay, are you thoroughly confused yet, or is this making sense to you? Okay, it'll make more sense as we push on and talk about it more. So I want to talk about what we're looking for technically. What do we want to see technically to get into a bull put spread? And then once we've looked at it technically, let's actually create a couple of these spreads and analyze them to help make sense of all of this. It's not uncommon for companies to have little plateaus like this and create a level of support. The more times a specific price point gets tested, meaning the price of the stock comes down to that price point and then goes back up, comes down to it, goes back up, comes down to it, goes back up. The more times that happens, the more this number becomes established as a level of support. When we are getting into a bull put spread, we are looking for a defined level of support, something that we can look at and not have to have a debate with ourselves or a debate with someone else that maybe we trade with. We need to be able to look at that and say, I can clearly see when I'm looking right here on this day, okay, pretend none of the rest of this is available to you right now. You're not seeing any of the rest of that. When I'm looking at this chart on this day, I can clearly see now that 91 has become a level of support. And it's becoming stronger as a level of support with each additional test of that number. My technical indicators are still bullish. I haven't had a crossover on the 5 and 20-day moving average. I haven't had a cross below the 50 line on the RSI, and we'll assume for purposes of this class that my MACD has not crossed over technically to the bearish side. So I'm getting more and more confidence that there's a level of support there that I can trust. That is a trend that helps give us some confidence that we may continue to go bullish. And it doesn't have to be strong bullish like this. We just need to feel as much confidence as possible that that level of support is going to hold. Happens again here. We've got 1, 2, 3, and a fourth test of a level of support again, right around $94 a share here. And when we can see that clearly, when it's very reasonable to look at that and say, that is definitely a level of support. And no small coincidence, it's lining up with what was a level of resistance here. It's pretty darn close if we drew a line right there to what our previous resistance was. Oftentimes, not always, but oftentimes, prior resistance becomes new support once it gets broken through. So we have that very identifiable trend and some confidence that we may get some continued bullish movement. We don't know that we're going to go this high, but by the time this has been tested a fourth time, we should have some confidence that it's probably unlikely, barring something really strange or some major world event or some major political event, it's unlikely we're going to come back down below there. So we get that definable level of support. And we suspect a continued bullish trend. Okay. Now, number one rule of the bull put spread is that we need support, identifiable support. That's why I emphasize this so much. We need identifiable support and a technically bullish trend. This would not have been the right time to get into a bull put spread. We had technical crossovers to the bearish side right here. After we've tested support here and crossed back over to the bullish side, then we are in a technical bullish trend, and this would have been an ideal spot to get into a bull put spread. Now, a question came in, would you ever do, let me read the question, would you ever use a debit spread if you can get paid to play? Technically speaking, that cannot happen. Technically speaking, that cannot happen. The very definition of a debit spread is that you are paying money to be in the trade. If you're trying to structure a debit spread of some sort and you're ending up with a credit, you're not in a debit spread. To my knowledge, it's impossible for it to happen. Now, there are some trades, and we'll get into these later in the program. There are butterfly spreads. There are some out-of-the-box condor type spreads where you could be structuring what you think is a debit spread, and it's not technically. You could end up with a little credit, and then you've got to look at your risk and so forth. But by definition, technically, you're not going to get into a debit spread and be paid. You're going to have paid money to be in it. So it's a good question, but you can't do a debit spread and get paid for it. It just doesn't work that way. Okay. So let's turn this trade that we were just looking at. Let's turn this chart that we were just looking at into an actual trade. We've got our stock currently trading at $100.97, and we now feel like at $100, we are seeing a level of support. Okay? Down around $100, we see a level of support. We're not going to ever place our short put strike any higher than that level of support. And if we can put together a trade that makes sense from a money standpoint, it would be nice if we could be a little bit below that level of support, but never higher. It needs to be out of the money. So if the stock is trading at almost $101 a share, we're going to put the strike price of our short put at $100 a share. And that's below where the stock is trading and never higher than where our current level of support is, but preferably a little bit lower. The long put gets placed at a lower strike price, same day or month, same day or month of expiration. Needs to have the same expiration date. Now, the net result of this trade is that we will take in a credit. Whatever we're taking in for this option, let's say hypothetically we're taking in $2 per share for this option. Probably we're only paying $1 for this option. And these are just hypothetical, nice round even numbers. But let's look at how the trade works. Think about and remember your rights and obligations of each of the option instruments. Okay? What is your obligation? Think back. Think back to level 2 in the education, and think back to when you heard me say several times, one of the best things you can do, in fact, I think I said the best thing you can do to learn how to trade correctly in this style of trading is absolutely thoroughly understand the rights and obligations of each of the option instruments. You need to know what your rights and obligations are of each of these option instruments. If we get from now, if today's the day we're opening the trade, and we get to the expiration of these short puts, and they're at a 100 strike price. If the stock is trading at $100 a share or more, what happens with this short put? I'm talking about what happens at the day of expiration. What happens to this short put if the stock is trading at or above $100 a share? Not even a penny below. It needs to be at or above $100 a share. What happens? Nothing, right? Nothing happens. The option expires worthless. The option absolutely expires worthless. And Joseph, you've got a great question. I'm going to get to your question in just a moment. I'm going to get to your question Joseph just gave a little bit of a clarification on the question he asked earlier about debit spread versus credit spread, and that's actually coming up in the presentation where I'll explain that to you. Okay, so if we are trading on the day of expiration, if we are trading at or above $100 per share, we are now released of our obligation on this short put. The $2 that we took in is forever ours to keep. That option has now expired worthless. If this long put is at a 95 strike and we get to the day of expiration and the stock is trading at or above 95, what happens to this put? If the stock is trading at or above 95, what happens to that long put at the day of expiration? It also becomes worthless. So if we end the expiration of these options, if we get to the expiration date of these options and the stock is trading at a higher price than the higher of our strike prices, all of these options expire worthless. Both options expire worthless, and we keep our credit. If we took in a credit of $2 and we paid a debit of $1, what was our net credit on the trade? Our net credit was $1 full, right? That's how much we make. And if both options expire worthless, we keep our dollar per share. And a lot of times it's going to be at least, if it's one contract, it's at least 100 shares, right? If it's 10 contracts, it's 1,000 shares. That's where we make our money on a credit spread. That's where we make our money on the bull put spread. We want the price of the stock to stay above the strike price of the short put so that both options expire worthless. Now, do we have to wait until we get to the expiration day of these options to get out of the trade? If we took in a credit of $2 for this option and we paid out $1 for this option, okay, we made a credit, we took in a credit of $1. This is the money in. This is the pay to play. This is what we got paid net to be in this trade. So what if I open this trade on the first day of August? It's going to expire, let's just say the 20th of September. Let's just make up a date here. Let's say I open it on the 1st of August. It's going to expire on the 20th of September. And I get to August 20th. So now I'm about 20 days into this trade. And I could spend $1 to buy back this option. Remember, I took in a credit. I would have to spend money to buy it back. And what if I only had to spend, I'm selling to close this option. Let me make sure I say the right things. What if I could take in, so this is money out to close the short put, and whatever I close the long put for is going to be money back in, right? So what if I could take back in 65 cents to close this? What would $1 money out and 65 cents money in be? What would the net be to my transaction if I had to spend $1 to close the short put, but I could take in 65 cents to close my long put? The net would be 35 cents money out, right? If my transaction started as $1 money in and 35 cents money out, have I made money? Have I lost money? Am I profitable? Am I not profitable? What's the net result of that? What is the net result of that? I took in $1, and now to release myself completely of my obligation, I've got to pay 35 cents. Didn't I just profit 65 cents? Okay, I just profited 65 cents. If we're getting closer and closer and closer to the expiration date of this option, and the stock is moving on a bullish trend and getting farther and farther away, the price of the stock is getting farther and farther away from these strike prices, these options are losing money, correct? They're both losing money. At any point in time, if I can buy to close this trade for less than what I sold to open it, I am making profit in this trade. Now, why is that important? Let me ask you a question right here. And this is a rhetorical question that you don't have to answer. I want you to think about it, and then I'll give you the answer. If I got into this trade at the 1st of August, and it wasn't going to expire until about mid-September, and I got halfway there on a bullish trend, I'm halfway between the day I opened the trade and the day these options would expire, and this thing is moving in an upward direction. That means I still have about maybe 2.5 to 3 weeks. I may have 2.5 to 3 weeks before those options expire. What can happen to the price of a stock in 2.5 to 3 weeks? Anything, right? I mean, if you want to think about it, on a given day, anything can happen, right? Anything can happen to the price of that stock. If I sold to open this thing for $1 per share, and halfway to the expiration, I could close it for 50 cents, is it worth it to you to stay in for 2 to 3 more weeks and take a chance that the price of the stock turns and does this, and you went from having a 50-cent per share profit to maybe losing money? Think about that. We're going to circle back around to that idea. Now, let's talk about our maximum risk for a moment in this trade. Well, okay, first let's go through our return on risk. So we know our maximum reward is the net credit of both options. In our example, we came up with $1, right? $2 money in for the short option, $1 money out for the long option, net credit of $1 money in. Okay, we know what our net credit is of the whole trade, both options. Now, we were looking at, what did we have on that screen? We had a 100 strike price and a 95 strike price. What is the difference between those strike prices? $5, right? Easy. That's easy. You don't need to answer that one. I'll answer it for you. $5 is the difference between our strike prices. If we subtract the credit that we took in from the difference in our strike prices, super easy math, that's $4, is it not? That is our maximum risk. That's the most amount of money we could lose on this trade is $4. Now, before I talk about option requirement, let me talk about that $4. Joseph, this speaks very directly to your question. Here is the dirty little lie about credit spreads. You ready for this? This is the dirty little lie about credit spreads. And unfortunately, I am aware of a handful of companies that people have paid huge sums of money to teach them investment education, that they conveniently gloss over this or leave it out completely. The dirty little lie about credit spreads is that when you think you're getting paid to be in this trade, you may at times have a lot more risk than your typical debit spread. Okay? And there's two reasons for that. Number one, when you do a credit spread, there is something called an option requirement. I want you to remember what this is. You need take some notes. If it helps enforce it to you, to write it down. If when you're done watching this class, you go to Investopedia and look up the exact definition, I want you to know what an option requirement is. As soon as I get paid this dollar by my broker, so the broker is facilitating the trade between me and another trader. There's actual person that has to be willing to buy the option that I'm selling, and there has to be someone who's willing to sell the option that I'm buying, but the broker facilitates that. As soon as my broker puts this dollar in my account, The broker does something else. He takes this $5 difference between my strike prices times whatever number of contracts, whatever number of shares are represented by the contracts I'm doing, and he puts a freeze on that money. And until I close this trade, either because it expires worthless or because I buy to close it, whatever the case might be, until the time that I close that trade or it expires, my broker freezes up this money. He holds this money, and I can't spend it even if I want to. I cannot withdraw it from my account. I cannot spend it on another trade unless it is to close this trade. The only way I could spend any of that money is if it's to close this trade. Until I am released of my obligation that I'm taking on in this trade, my broker is going to hold the entire amount of money that is the difference between these strike prices times the number of shares represented by my contracts. Let's use some real numbers for a moment. Let's say we did 10 contracts. 10 contracts is equal to 1,000 shares, right? 1,000 shares. And so here's what happens. I want to be real specific about this for a moment to illustrate this picture. If these were the exact numbers we were getting, $2 money in, $1 money out, and let's say we started out with an account. Let's say for a moment that we had an account of 12,000. I'm going to just dream up a number here. $12,376.15. Okay, that was the value of our account before we opened this trade. We have $2 money in. We have $1 money out. The second we place this trade, we get an infusion of $1,000 into our account. That's a very real thing. Our account value will instantly go up by $1,000. Suddenly, we're at $13,376.15. This is not counting commissions. It'll be a little less than that because you'll pay your $15, $20, $30 for commissions. But your account will immediately go up by $1,000. And then in the blink of an eye, this is happening electronically. This is happening through a computer algorithm. You don't even see it happen. There's not time to think about it. It's automatic. Your broker immediately takes $5,000 of this money, the difference between the strike prices times the number of shares represented by our 10 contracts. So $5 a share times 1,000 shares. Your broker takes that $5,000 and he puts a freeze on this. You cannot touch that money until you have been released from this obligation of this short put. So suddenly you have $8,376.15 available to you in your account. That's how much you have available. So, Joseph, here's the answer to your question. When you place a credit spread, this money is unavailable to you just as if you had spent it on a debit spread. Let's say this same trade, 95 strike price long call, 100 strike price short call, and let's say it cost us $2.15 as a debit, money out to be in this trade. Our $12,300, and let's say we did 10 contracts, our $12,376 per share, or excuse me, sorry, not per share, our $12,376.15 account goes down by $2,150. And $12,376.15 minus $2,150 means we have available to us still $10,226.15. Same number of contracts, right here and right here. Same company, same strike prices. One's a credit spread, one's a debit spread. Both of them could benefit from a bullish move. Both of them could make their full profit if the stock stayed above $100 a share. Over here, we've only got $8,300 available to us in our account, and over here, we've got $10,200 available to us in our account. The freeze your broker puts on this money takes it away from your ability to use it, no different than if you had spent it on a debit spread. And that's why I call it kind of a dirty little secret, a dirty little lie. We think we're getting paid to be in a trade, and technically, by definition, we are taking money in when we open that trade. And technically, that $5,000 is not leaving our account. It's just froze up and unavailable to us. It's unavailable to us as if it had left our account. And just like that $2.15 per share that we spent on a debit spread, hopefully when we close that, we're going to bring in like $3.50. But there's no that this money is not available to us until we bring it back in through the close of the trade. Just like that $5 per share is not available to us until we release our obligation by closing the trade. Okay, and then we talked about it a little bit when we were defining the trade. The return on risk is calculated simply by dividing the maximum reward by the maximum risk. If our maximum reward was the dollar credit that we took in, so forget about the debit spread, now we're back to the credit spread. If our maximum reward was that net $1 credit money in, that's the maximum reward. Our maximum risk is $4 per share. Okay, we took some time to calculate that. The difference between our strike prices, which is $5, minus the maximum reward or the net credit we take in. And if we just divide this by this, our maximum is 25%. $1 is 25% of $4. That's the maximum possible return we could get on a $5 spread with a $1 credit. Now, I know this might be disappeared off the bottom of your screen. A good target return on risk is 15% or more, with rare exceptions. And I will share with you one of those exceptions, but with rare, I'll do it at the end. With rare exceptions, we want that to be at least 15% or more. So here's what an actual trade would look like if we use real prices on real stocks. So there's an option chain for Visa. $100 strike price is currently paying a credit of $149, and the 95 strike price long put. So there's the money in for the short put. There's the money out for the long put. Our net credit to be in the trade is $1.09 per share. That's our maximum reward. But our maximum risk is the difference between these $5 strike prices and the credit that we took in, so we have at risk $3.91. Our maximum return on risk would be 28%. That would be a good credit spread. That would be a good credit spread, 28% or more. Now, if we got to within 2 weeks of this expiration day and we could get out with 15%, I would do that every single day of the week. I would do that. I would never hesitate to take half or more of my target profit and get out if I've got 2 weeks or more left in that trade. Because I don't want to run the risk that something weird happens in the economy, in politics, in geopolitical events. You know, I don't want the North Koreans to test another ballistic missile that lands 100 miles off the shore of Hawaii. And they're claiming they can hit Hawaii with one right now. Do you know how the markets would be shaken if they actually did a test and splashed a rocket 100 miles off the shore of Hawaii or Alaska? I hate to be a pessimist and a doomsday thinker like that, but that would shake our markets. It could be some economic announcement. It could be some political announcement locally here, a homegrown political thing. Congress can't get its act together. We're never going to get tax cuts. The markets are going to sell off. I don't want to take that risk. And if I can get half or more of my target profit with less than 2 weeks till the trade expires, I'm taking it. Now, I want to talk a little bit more about this maximum risk. Let's make sure this is very well defined. And this goes back to that thorough understanding of your rights and obligations of the trade. If this stock suddenly, if here's our $100 price, and here's our 95, if these were sitting there on a stock chart, there's 95 and there's 100, and suddenly the stock started to go down, okay, as soon as that stock is trading below $100 a share, what now happens to our obligation? Yeah, another question came in. Could you put in a good until closed order right after opening the trade? You absolutely could do that. You could absolutely do that. There'd be nothing wrong with it. I don't always do that. If it's trending my way, I may get to that couple week mark before I do something like that, see if I'm getting an even better return faster, not getting out too quick, but there would be nothing, that would be a very prudent thing to do, and I would never argue against being prudent. Okay, let's say the stock suddenly starts to trend down, and now our short put at a 100 strike has gone from being out of the money to in the money. If the stock is trading at $98 a share, what is our obligation to that short put? The person who gave us that $1.49 right here, the person who gave this to us, they have the right to sell us their stock at $100 a share. And if they decide to exercise their right to do us, that stock is put to us. If they exercise their right to do so, the stock is put to us at $100 a share. Well, we don't want to own $100 a share stock that's currently trading at 98, right? Of course not. We don't want to own a stock for 100 that's worth $2 less than that. But if that were to happen and we could immediately sell our stock at $98 a share, we would still keep this whole credit right here. That would all still be ours. So the damage would be minimal. We would only lose about 91 cents a share. That's kind of big from a percentage standpoint, but that's not a horrible thing. Not when we have $3.91 at risk. If we lost 91 cents, that'd be about a 23% loss. Don't get me wrong, I wouldn't be happy with any loss, but that's what would happen. But what if the stock got down to $94 a share and stock got put to us at $100 a share? We don't want to turn around and sell it at 94. That would be a $6 per share loss, and we only took in $1.09 on this thing. We'd lose $5.91. Excuse me, $4.91. The long put, what's our right with a long put? Just like the person here had the right to sell us their stock at 100, we have the right to turn around and sell someone else our stock at $100, or excuse me, at $95 a share. So if the stock starts to move down, this 95 strike price long put, that protects us from having any more than this risk right here. So with all of that in mind, what is our theoretical break-even point? Now, theoretical break-even always means, whenever we say theoretical break-even, if at the day of expiration, at the moment of expiration, where could the value of the stock be such that we would not take a loss on the trade? No, I'm not counting commissions. Where could the value of the stock be such that we would not take a loss at the moment of expiration? Okay, we had one answer that came in that $100 and a penny. Now at $100 and a penny, we'd make our full profit. Anything at $100 or higher, we would actually make our full profit. How low could the stock go such that we would not take any kind of a loss? Okay, I want you to remember this. This is another one of those things that's worth writing down, because it's not going to come in as a bullet point. I want you to write this down. If you have stock put to you early, if prior to the expiration date or at the day of expiration, if any time between the time we open the trade and the day of expiration, if we have stock put to us early, this is ours to keep now. There is no longer an obligation to our broker. We've been released of our obligation. That is ours to keep. Now, we may be released being stuck with 1,000 shares of the stock if we were doing 10 contracts, but we can now turn around and immediately sell that stock, right? And we can either sell it at $95 a share if the stock is trading below 95, or we can sell it wherever it's trading between 100 and 95. We don't take our maximum loss unless the stock is trading below 95. Anywhere between our theoretical break even and 95, we'll take a loss, but it's not our maximum loss unless we get clear down to 95 or below. Okay? Take your strike price of your short option and subtract your credit from it. Okay? Take the strike price of your short option and subtract the credit from it. Okay, our theoretical break-even point in this trade is $98.91. Now think about this. Here's what I want you to think about. Okay? And then I'll answer another couple questions that came in. If we have stock put to us at $100 a share, and we turn around and sell it at $98.91, how much of a loss does that represent? Okay? Buy a stock for $100 a share, which is our obligation. We have to do that. We buy a stock at 100. We can turn around and sell it manually by ourselves for $98.91. That's not good. You don't want to buy high and sell low with stocks, but that would cost us $1.09, right? At $98.91, how much is this option worth at the time of expiration? How much is that worth at the time of expiration? Zero. It's not going to be worth anything. So we lost $1.09. Again, this is not counting commissions. We lost $1.09 buying stock at 100 and selling it at 98.91. But we kept the $1.09 credit that we opened the trade with. That was money in. We just broke even on our trade. Anything above 98.91, and there is some little bit of profit. Not a lot. It's not going to be much. If the stock was put to us at $100 a share and we sold it for $99.10, we're going to take a 90-cent per share loss right there, but we still kept our 109, which means we made 19 cents per share. At least there was some profit in. That's money into our account. There's some profit there. Okay? Between 98.91 and 95, anywhere between these two numbers, I know those are going in the wrong direction for stocks moving up and down, but anywhere between 98.91 and 95, we're just going to get closer and closer and closer to our maximum loss. Once we go below 95, we cannot lose more than this amount. If we had to buy stock at 100, turn around and sell it at 95, we take a $5 loss. That's the money our broker held. The reason our broker held that money is to make sure we fulfill our obligation. We have to buy the stock at $100 a share. We're not going to sell it for anything less than 95, even if it was trading at $85 a share now. We can still sell it for 95. So we're going to lose that $5, but we get to keep our 109, and that's where that 391 maximum possible loss comes into play. But anything between 95 and 98.91, it lowers this loss. Real quick example, and then we'll move quickly through the remainder of this. Real quick example. Let's say the stock price ended right on this strike price of 97.50. Right there at 97.50, the stock, we got to expiration, or before expiration, the stock was put to us at $100, and the stock is currently worth $97.50. We're going to take a 250 loss right there. But from that 250 loss, we can subtract the $1.09 that we brought in. And 250 minus $1.09. Our loss in that case is only 141. So we're not nearly as bad as a 391 loss. In fact, we've lost less than half of that much. So anywhere between that 98.91, that's our theoretical break even, down to 95, that's where we can lose money. And then we cannot lose any more than that beyond 95. All right, let's keep moving. Let's just show another example. It is not a bad idea at all when you're looking for the technicals for a bull put spread to have had recent bullish technical crossovers, but be cautious about where that support and resistance are. In this case, you might find some really attractive numbers for a bull put spread right here, but that stock is right there testing a level right now of what could end up being pretty strong resistance. Be really cautious in that. Having those technical crossovers to the bullish side can be a really good thing. Watch where your levels of support and resistance are, because we don't know if this stock can go this much higher. We don't know if it can break through. Now, if we've got a strike price down below where that crossover came, we might still be okay. A short put strike price. Here's that trade, just an example. I'm going to go through this really fast. If we place the short put at 150, the long put at 145, hope for that bullish trend to continue. Okay. We talked about the option requirement. We talked about the money your broker is going to freeze up. Make sure you can handle that option requirement, and make sure that you can own the stock even temporarily if it's put to you at that short put strike price. Okay, this could be a really attractive bull put spread. The numbers on this are great. 34% possible return. Well, you got half of that in a couple weeks because the stock was still moving bullish. You have a nice 17 to 20% return. Not have to stay in the trade till expiration. There's not even quite as much risk in this one as the other example that we gave. But this one would scare me a little bit because of that level of resistance that's kind of hovering above my head, so to speak. Now, I talked about this enough. We'll just bring the rule in and introduce it right now formally. If you can get half or more of your target profit with more than a couple weeks left to option expiration, take it every time. Now, there's a huge difference between the option requirement and the ability to own a stock. Okay? Let's say we just saw an attractive trade that we wanted to do one contract of, but it was on Amazon, and Amazon is currently trading at $992 a share. Well, if we got a $2.40 credit for the trade, see, oh, I put these numbers are wrong. Sorry. Okay, these numbers are wrong right here. I'll fix this on the fly. We'll have to fix. Okay, so our 985 strike put is $22. Let's correct this. That's a $22 credit. That's a huge credit. But we're going to have to pay $20.50. So this becomes a $1.50 credit. $1.50 per share credit. Okay, $5 minus that $1.50 is $3.50. And that's a good trade, right? What is our option requirement going to be on this trade? Sorry, I got these numbers wrong. As I was updating some brand new option chains, I forgot to fix a couple things here. What is our option requirement? Let's say we did this with 3 contracts. Let's test you a little bit. 3 contracts. 3 contracts is equal to how many shares? 300 shares, right? Our option requirement to be in this bull put on an expensive stock is going to be $1,500. And we could potentially make, what, $1.50 times 300 shares? We could potentially make $450. That's that, what is that? 450 divided by 1,500? In fact, it's not even divided by the full 1,500. It's $450 divided by 1,050. You know where I'm getting that 1,050 from? My maximum risk of 350 times 300 shares. This is potentially a 43% return on this trade. That's fantastic for a bull put spread. Handling that option requirement may be a relatively easy thing to do. If stock was put to me at $985 a share right now, times 300 shares, you know how much that is? 985 times 300 shares? That's $295,000. No, that's wrong. I'm sorry. $985 a share times 300 shares. No, I'm sorry. That was correct. That was actually correct. $295,000 to own 300 shares of Amazon stock right now. Now here's a. I want to complete this thought and make this very coherent. I don't go off a script when I'm teaching these classes. A lot of times people look at a smaller price stock and their automatic assumption is this is a better trade for me to be in on a credit spread, because here we've got our September 1750 strike and our September, I thought I had that moved down to the 15 strike. I forgot to move that. Let's use these ones instead. Oh, I'm sorry. This, I did mean for this to say 1250. Boy, I'm all over the place here, aren't I? Okay, we'll make sense of this. Scratch the 15. So 1750 strike short put gives us a 49-cent per share credit. $12.50 strike long put we pay only 6 cents for. So we're getting a net credit of 43 cents per share. That's really attractive, right? That looks really good. But it's the same option requirement. If we only did 3 contracts here, we have the same $1,500 that our broker is going to freeze for us. And a 43-cent credit, we're not going to make nearly as much, but the difference might be 300 shares of stock put to me at $17.50 a share is only $5,200. This one would cost me $5,200 to own the stock for a period of time. This one would cost me, what did we say it was, $285,000? Everyone is different. Everyone trades with a different size account. There's some investors that this might be nothing to them. And there's some investors that couldn't even come close to owning that number of shares right now with their portfolio. You've got to consider not only the option requirement, which on a really expensive stock or a really inexpensive stock can be exactly the same, but you've got to consider, can I afford to own those shares for any amount of time? Primary exit strategy for the bull put spread is to let both options lose value or maybe even expire worthless. The target return is always going to be a fixed number because the net credit will not change once the trade is open, and we want minimum of 15. When you're willing to take less, I told you we'd talk about this at the very end of the presentation, the only time you should be willing to take less than 15% is if you see a credit spread you really like that could be open for less than 4 weeks. If you've got some great option prices and you could be in that trade for a week, 2 weeks, and get an 11% profit or a 13% profit, you might on occasions do that. Everything else technically better look real good for something like that. 4 weeks or less is ideal, but there will be times when you're going to get a much better credit just going out to a 5th or a 6th week, and that's not a bad thing to do. That's not a bad thing to do. 5 or 6 weeks is not horrible if you get a much better risk to reward ratio. But our goal is to be in the trade for 4 weeks or less. Getting that much better risk to reward ratio means we should be a little more willing to pull the trigger and get out faster when that thing is going our direction. Review of the rules real quick. We got to have those support and technically bullish trend. Minimum return needs to be 15%. Don't forget about that option requirement and the ability to own the stock if possible, even for a short period of time. And if you can get half or more of your target profit with more than 2 weeks left to expiration, take it every single time. When a stock has established an identifiable level of support and has a short-term expectation of staying stagnant to slightly or very bullish, the bull put spread can take advantage of that. Strong level of support and closer option and expiration date helps this trade work better. Make certain that there is no fixed event like an earnings report that takes place between the time you open the trade and the expiration of your options. You may need to stay in this trade right up until expiration. Different than a lot of our credit spreads, you don't, in a lot of our debit spreads, there can be an expiration date that exists, or excuse me, an earnings date. There can be an earnings date that exists between the time you open your trade and the day your options are set to expire. You just have a goal to get out before that. That's going to be your goal, is get out before that. Not the case with a credit spread, not the case with the bull put. You do not want there to even be a scheduled event between the time you get in and the day your options are expiring, if you can help it. Good target return, anywhere from 15 to 50% is great, minimum 15. And if you can spend less than 4 weeks in the trade, that is fantastic. Folks, that wraps up the bull put spread. Our next class, we are going to talk about adjusting the bull put spread. Thank you for your participation, for some great questions today. Have a great day. Bye-bye.